Wanda, many of the youth that are taking part in this program are just starting to learn kind of basic finances. Can you take a moment to discuss the differences in a checking account, a savings account, and a money market account?
Sure. So as I previously said, the earlier you can start a child in learning about finances, the better. And a savings account is always a good way to start because it's a basic interest rate earning deposit account, as well as the money market. Now, the money markets are usually going to require some sort of minimum balance, and some sort of minimum requirement deposit. Because it's going to earn more interest. Lately, that has not been the case because everything is earning nothing. Some financial institutions, and I don't want to digress too far, some financial institutions offer different rates based on how much money you're going to put on deposit. State employees credit unions at this point is not like that. We do have a new leader, president now, and some things are going to change. So that might be one of them because we want to reward our members and for what they've saved, and they want to earn a good amount of interest on it. So it's called tiering. And so I do believe that at some point we're going to start doing that because if you have $100,000 and I have $100,000 and we have it on deposit at the same financial, well, let me rephrase that. If you have $100,000 and I have $100, if we're at the same financial institution, if you have 100, because the financial institution earns money off your money, they use your money to do loans. So you want to get some money for your money sitting there. And you don't want to get the same amount of money I'm getting because I only have $100 sitting there. So, and the credit union's way has always been, it's always fair across the board. So that's been good, for lending, because when some people don't have good credit, they still get the same rate as people who have the good credit. But it's also not fair to people who have good credit, should get a lower rate and a higher interest rate on deposit. So I digressed a little bit on that. But that's the difference between a savings and a money market. A savings account, you're going to be able to just, put whatever in, whenever in. And both of those accounts are usually going to be accounts that you have to go into the branch to withdraw from or make deposits, unless they have like mobile deposit or other avenues that you can make the deposit. But it's not going to give you a debit card or anything like that where you can go into a grocery store like a checking account, and that's the difference, which makes starting with a savings or a money market a better way to introduce financial literacy because you have limitations. A checking account, you don't. You get that card and see one thing young people, old people think is that the card is going to stop you from using it. But the fact of the matter is when you get a debit card to a checking account, one, the money is not on the card. Those are called reloadable cards, and you get them from stores. When you go to a financial institution, they give you a debit card to your checking account. That card is just a key to your account. So if you don't have $50 in your checking account at the bank, then you can't go swipe your card for $50 because that's just a key to your account and you don't have that in your house. So it's gonna unless you've been at $50 for a long time, and this is a little technical, unless you've been at $50 for a long time, the Visa system doesn't know that you don't have that money, so it'll overdraw you. So that's a problem. Then you start incurring fees and things like that because you didn't have enough money. Because what you say when you sign your documents and you come in and say, I want a checking account, it's not just we're doing each other a favor. It's a relationship. So you're saying, I'm going to be responsible for only using the money in my account. You're giving me this card so I can have access outside of the financial institution when I want to go get gas or go to the store or go to the movies or whatever it is, you might be doing. This card will give me access to my account. So I'm going to be responsible. So when you're not responsible, then it costs the financial institution. And so the fees are incurred to make up for that. So a lot of times people get upset. Well, you charge me this, you charge me that, but it's a relationship, and everybody's, and the financial institutions are businesses, and so when you make a commitment and you don't keep it, then you're penalized to some degree. Just like if your card is compromised and someone has gotten it and they charge, you'll call us and say, those aren't my charges, I lost my card and somebody did it, and we get your money back for you. It's a relationship. So that's why when early on I like to say, children need to have a financial relationship with some institution, because that's what you have with them is relationship, and that goes into lending, which is even a little bit more detailed. So you have a commitment. You have a commitment to the checking account. So checking account is always something I say save for when a child has a job, when they're working and they're actually going to have money coming in and going out, possibly for maybe car insurance or whatever it is they might be starting with, or just a camp or whatever it is they're contributing to in their life. Then that gets a little bit more detailed and difficult. But if you start with a savings or a money market, you have some basics down.